Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of strategies to minimize reinvestment risk in your portfolio. Understanding reinvestment risk, a vital guide for investors in 2024. Ever wonder why reinvestment risk is a buzzword among investors? It's a concern that's hard to ignore in today's financial climate. When investments mature or deliver payouts, you often face a dilemma: where to reinvest without diminishing returns. This is the crux of reinvestment risk. In 2024, understanding this risk is crucial as markets fluctuate and interest rates shift. Our guide will break down the essence of reinvestment risk, offering insights into how it impacts your investment choices and what strategies you can employ to mitigate it. Stick around to learn valuable insights that could redefine your investment approach this year. Breaking down reinvestment risk. The specter of reinvestment risk hangs over every investor's portfolio, weaving its way into decisions that dictate financial futures. It's a risk not often shouted about but quietly acknowledged in the boardrooms and breakfast tables of investors worldwide. This section sheds light on what reinvestment risk is and why it matters so much to your investment strategy. Definition and explanation. Reinvestment risk is the chance that an investor will not be able to reinvest cash flows or principal repayments at the same rate of return as the original investment. Imagine having a go-to-favorite coffee shop, and then suddenly, it closes. You're left searching for another spot that can serve your coffee just the way you like it. That's similar to how reinvestment risk works. You might not find another investment offering the same returns as your last one. This risk is particularly prominent in fixed income securities, like bonds. When these investments mature, or when they pay interest, you might have to settle for a lower interest rate in a different market climate. It directly affects your future earnings and overall financial health. Importance and investment strategy. Understanding reinvestment risk is crucial for smart investment strategy, especially when dealing with bonds and other fixed income securities. Why? Because interest rates fluctuate, and they don't always move in your favor. Let's say you originally bought a bond offering good returns. When it matures, and you try to reinvest, the available interest rates may have dropped. Ignoring reinvestment risk can hurt your returns. Here's why it's vital to keep it on your radar. Market environment. Interest rates can shift rapidly due to economic changes, affecting all fixed income products. Long-term planning. If you rely on fixed income for future plans, like retirement, lower reinvestment rates can eat into your expected income. So, what's the takeaway? Always consider reinvestment risk when crafting your investment strategy. It's the quiet thief of returns, but with careful planning, you can guard against it. Types of reinvestment risk. Navigating the maze of reinvestment risk can feel like walking a tightrope without a net. While each step involves uncertainty, understanding the different types of reinvestment risks can minimize surprises. Get ready to explore the twists and turns of this financial journey. Interest rate reinvestment risk. Interest rates are like the weather, always changing and beyond anyone's control. For investors, this variability is a source of reinvestment risk. When interest rates drop just as your investment matures, your potential returns shrink. Imagine getting used to a refreshing high rate, only to find yourself stuck in a drizzle of low rates. This isn't just a disappointment, it's a reality check. Your challenge becomes finding a new investment that keeps the momentum going without losing steam. The takeaway? Keep your eyes on interest rate trends and be ready to adapt your strategy as they shift. Default reinvestment risk. Picture this. You've counted on timely cash flows from your investments, and then a default hits like a curveball in the 9th inning. Default reinvestment risk is about dealing with these unexpected surprises. When a security defaults, any expectation of consistent returns goes out the window. You're left scrambling to reinvest these cash flows into something with similar, if not better, returns. It's like searching for a new starting line after your race just got interrupted. To manage this risk, diversify your portfolio and keep a buffer, so you're not caught off guard. Call risk. Callable bonds might seem like a safe bet until they're suddenly snatched away when interest rates dip. Call risk is the looming possibility that these bonds will be called before they reach maturity, leaving you to reinvest in an environment with fewer perks. Think of it as planning a road trip only to have your car recalled before you leave. Callable bonds have this built-in risk because they're advantageous for issuers, not necessarily for you. Stay vigilant about the terms of your investments and look for alternatives that offer similar returns without the added stress. Factors influencing reinvestment risk. Reinvestment risk is like a shadow that lingers over every investor's choices. It's not just a silent companion, it's an active player in wealth-building strategies. Understanding what molds this risk is key to navigating the investment world effectively. Below, let's explore two critical factors that heavily influence reinvestment risk. Interest rate movements. Interest rates are the heartbeat of investment strategies. They change with time, dictating the rise and fall of potential returns like the ebb and flow of a tide. But how do these fluctuations create reinvestment risk? Lower interest rates. When interest rates drop, finding new investments that match previous yields becomes challenging. Imagine you're used to a gourmet meal, and now you're being offered fast food. The satisfaction just isn't the same, and neither are returns. Higher interest rates. On the flip side, rising rates might seem beneficial, but they can present a new dilemma. Bonds you bought previously might now yield less than what new investments offer. You're stuck with yesterday's newspaper while the latest news is yet to be read. Interest rate movements are a race against time. When they swing, so does your ability to garner expected returns. Staying informed on economic indicators can help us stay a step ahead or be ready to adapt strategies as needed. Economic conditions. Economic conditions dictate the environment in which investments breathe. Think of it as the weather system of the financial world, influencing everything from interest rates to market confidence. Economic expansion. In times of growth, interest rates tend to rise as demand for money increases. It's a double-edged sword. While new investments might offer better rates, existing ones could fall short. Savvy investors need to strike a balance between old and new opportunities. Economic contraction. During economic slowdowns, interest rates often fall to encourage borrowing and spending. For investors, this translates to a tougher time finding lucrative reinvestments. It's like searching for sunshine on a rainy day, but still needing to plan your future picnic. Economic conditions are always in motion, sending ripples through the financial seas. Recognizing these shifts and understanding their potential effects can be the key to managing reinvestment risk wisely. Measuring reinvestment risk. Understanding how to measure reinvestment risk is a crucial step for any investor, especially in an ever-changing financial environment. It's about identifying potential pitfalls before they affect your bottom line. To get a handle on this risk, we can use a few key concepts that will help quantify and manage it better. Duration and convexity. Think of duration and convexity as the lens through which you can view an investment's sensitivity to interest rate changes. Measuring duration tells us how long it will take for an investment to repay its cost with its income. It's like knowing the time it takes to finish a marathon, critical if you're trying to pace yourself for long-term gains. Duration. This gives us a snapshot of how much a bond's price is likely to change with a shift in interest rates. A higher duration means more sensitivity to interest rate changes, thus greater potential reinvestment risk. Imagine it as the tightrope between stability and return. Convexity. This complements duration by providing a more accurate picture, especially for large interest rate changes. If duration is the tightrope, convexity is the balancing pole. It helps fine-tune our understanding of reinvestment risk by considering the bond's curvature, or how the duration changes as interest rates shift. By analyzing both these factors, investors can better predict how their investments will behave with changing rates, allowing them to strategize accordingly. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.